After Wells Fargo's bail-in policy went public, thousands of their customers did exactly the same thing. They packed up and moved everything to a credit union. And look, if you were one of them, I completely understand. You looked at the endless scandals, you squinted at the fine print and said, absolutely not. I'm taking my money somewhere I can actually trust. You walked into a building that smells faintly of potpourri, opened an account, and they called you a member owner. You're opting out of the greedy, systemic casino of Wall Street. The rationale, it makes sense, but unfortunately, you didn't escape the blast zone. You just traded a massive corporate frying pan for a slightly more folksy, community-based fire. Here's what that means for your money, and exactly what you can do about it right now. You see, after the 2008 financial crisis, the government passed Dodd-Frank. Under its orderly liquidation authority, if a massive bank fails, regulators have the legal power to do what's called a bail-in, not a bailout, where taxpayer money rescues the bank. I'm talking about a bail-in, where your money rescues the bank. Your deposits get converted into equity to keep the institution breathing. So why is that legal? Because when you deposit money at a bank, you are not a protected saver. You are an unsecured creditor. Legally, that is your classification. You loaned them your money. And in the priority line of who gets paid back during a collapse, you are standing behind secured creditors, administrative costs, employee wages, taxes, and debts owed to the U.S. government. You are effectively last in line for anything above that $250,000 insured ceiling. That's what you were running from. And that instinct, again, was correct. The problem is where you landed. If you've got it handy, grab your account agreement. It's the document you were handed, or more likely emailed and never opened when you first opened your account. It doesn't matter if it's from Wells Fargo or your credit union. Look up your institution's insurance status, resolution materials, and coverage rules, not just the marketing brochure. What you're going to find is this. The language describing what happens to your money if the institution fails is not hidden. It's not buried. It is there, and it says exactly what I just described. You are a creditor. You have a claim. Your claim is processed in a specific order, and that order does not put you first. The system didn't hide this from you. It just knew you wouldn't read it. Now, credit unions. I am not going to tell you credit unions are the same as Wells Fargo. They are not. Credit unions are member-owned. They're not for profit, and they are not subject to Dodd-Frank's bail-in framework. That applies specifically to systemically important banks. So on that front, you moved in the right direction. But lower risk is not no risk. And there are three things about your credit union that nobody mentioned when you made that switch. Number one, the creditor line is the same. When a credit union fails, the NCUA steps in as liquidating agent. Their payout priority is governed by federal regulation 12 C.F.R. section 709.5, and the order looks like this. Administrative costs first, wages second, taxes third, debts owed to the U.S. government, including the NCUA itself, fourth. You are not on the VIP list. In fact, you're nowhere near the top of the list. You are waiting for a table at the Cheesecake Factory on Mother's Day, and the host doesn't really care if you get to eat today or not. And that member owner title they give you when you walked in, it looks great on a canvas tote bag, but it does not move you to the front of the payout line. Members are paid only if a surplus remains after every high priority claim is settled in full. Number two, the $250,000 ceiling, it's the same ceiling. Now, here's something I want to be precise about because this matters. Everything I'm about to say applies to the money above the insured limit. If you're under $250,000 per account category, that money has never been lost, not once, not in the history of either the FDIC or the NCUA. What we're talking about is what happens to everything above it, and whether you even know where that line is for your accounts. FDIC protects bank deposits up to $250,000 per depositor per institution. The NCUA does the same thing through the National Credit Union Share Insurance Fund. Same number, same per institution limit, same math problem underneath it. As of the fourth quarter of 2025, the FDIC's fund stands at $153.9 billion with a reserve ratio of 1.42%. The NCUA's share insurance fund carries $24.1 billion in assets against $1.86 trillion in insured shares and deposits, an equity ratio of 1.3%. Expecting those funds to cover everyone in a genuine systemic crisis, it's like trying to put out a forest fire with a single lukewarm LaCroix. It's a nice gesture, but the math doesn't hold if everything fails at once. And look, they've always come through. Every insured depositor has been made whole every single time. But when SVB collapsed in 2023, the FDIC had to invoke emergency authority and then charge the entire banking industry a special assessment just to cover the gap. Now, that's not a guarantee failing. That's a stress test that revealed exactly how thin the margin is. It works until it has to work for everyone at once. Number 3, and this one might apply to you right now. Not all credit unions are federally insured. Some state-chartered credit unions use private share insurance instead of NCUA coverage. Ohio historically had an entire parallel private insurance system for exactly this. Private insurance means no federal government backstop, no full faith and credit of the United States behind your deposits. If you moved your money from Wells Fargo to a state-chartered credit union with private insurance without checking, you didn't just leave the frying pan. You left federal protection entirely without realizing it. You may be thinking, hey, this is theoretical, worst case. I mean, credit unions don't actually fail like banks do. Well, in 2009 and 2010, 5 large corporate credit unions, U.S. Central, West Corp, Members United, Southwest Corporate, and Constitution became insolvent. Now, these weren't your local branches. No, these were the wholesale institutions that held reserves and provided liquidity for thousands of retail credit unions across the country. The institutions that your credit union depended on. They had loaded up on toxic residential mortgage-backed securities, the same instruments that brought down the big banks. The NCUA placed all 5 into conservatorship and liquidation. And when the dust settled, capital holders received nothing in distributions from these estates. Recoveries have been deeply limited. The official government materials don't use dramatic language. They just note matter-of-factly that a distribution will not be made. That's bureaucratic language for you're not getting it back. This isn't a hypothetical. It has a date. It happened inside the credit union system to the institutions that sit one level above the branch where you opened your new account. The fire at the credit union is smaller than the fire at the bank. I'll give you that. But it is still a fire. So what do you actually do? Because I'm not leaving you with just the problem. No, 3 moves right now. First, verify your insurance today. Go to ncua.gov or look at the footer of your credit union's website. You are looking for the official logo that says federally insured by NCUA. If you see privately insured, you have no federal backstop, and you need to know that today, not later. Second, know your coverage per category. It might not be exclusively to the institution because the $250,000 limit applies per ownership category. Single accounts, joint accounts, and IRAs are each counted separately. Each union is a little bit different. If you structure your accounts correctly across categories, you can have significantly more than $250,000 covered at a single institution. If you haven't done this, you may be sitting on uninsured balances right now without realizing it. And third, diversify across institutions. This is what people with real financial infrastructure have always done. They don't concentrate. No, they spread it out. And not because any one institution is guaranteed to fail, but because the protection system is built around per institution limits. Use it the way it was designed to be used. And the comment from the last video that started this video was someone who said they'd been at their credit union for 40 years. They felt safe. They felt proud of the decision. And honestly, they're probably right to feel that way. Their credit union is likely fine. Most are. But here's the thing. We've spent this entire video focused on what happens if the institution fails. And that's worth knowing. But the harder truth is, the institution doesn't have to fail for you to lose. The money itself can fail. Inflation doesn't need a bank run. It doesn't need a resolution event. It doesn't need a government report or a liquidation notice. It just needs time. And it's been working quietly, legally, relentlessly. You know, that $100,000 you protected in 2010, in real purchasing power today, it's worth about $70,000. The bank didn't take your $30,000. The FDIC didn't lose it. Nobody failed. The money, it just disappeared while you were doing everything right. So yes, know the creditor line, structure your accounts, verify your insurance. That's half your active defense. The other half, the one that actually determines whether you come out of all of this madness ahead, is what you hold. Income producing real estate is still my go-to, but you've got options. And diversifying here, like you should with your banks, is looking more and more like a good idea. A great idea, actually. And that's why I pulled this video out right here for you to watch next. Because while cash was losing a third of its purchasing power over the last 15 years, gold did something very different. And if you're considering it as a part of your plan, know that it's not foolproof. It is possible to lose the moment you purchase it. It's a dirty world out there. And I don't want that to happen to you, all right? So watch this next. God loves you, and so do I. Take care.